Dell jumped 16.8%. Lab scores at 66 out of 100. Buy. Their AI racks push 120 kilowatts per cabinet, double competitors. Liquid cooling manifolds are pre-plumbed at the factory, cutting site install time by 40%. The full teardown exposes why NVIDIA's Blackwell deals are locked to Dell's chassis. Dell's AI server dominance is a fragile engineering triumph. It is limited by 100 kilowatt thermal density. Wall Street focuses on server shipment volume. The real physical bottleneck is the transition to direct-to-chip liquid cooling. Dell's PowerEdge XE9680 utilizes custom manifold systems to cool 8 NVIDIA Blackwell B200 GPUs. Each B200 GPU draws up to an unprecedented 1,200 watts of TDP. Supermicro struggled with cooling leaks. Dell won massive market share by standardizing its proprietary CDU design. By mastering this thermal plumbing, Dell secures high-margin enterprise deployments that competitors cannot service. This hardware execution explains why the stock surged 16.77% today to close at $295.19, pushing its market cap to $192 billion. This massive rally represents a 71% outperformance against the tech sector over the last 30 days. However, this engineering premium has pushed Dell's RSI to 74.7. This overbought signal indicates that while Dell's liquid-cooled manifolds are structurally superior, the stock price has temporarily outrun its physical deployment capacity. Today's vertical move reflects Wall Street finally pricing in Dell's thermal engineering mode. Quarterly financials showing modest revenue momentum for Dell. Dell's 16.8% surge is a temporary high tide masking a severe margin squeeze from a 4.57% 10-year Treasury yield and aggressive import tariffs. While Wall Street celebrates Dell's 39.5% revenue growth, a massive macro wave is shifting. The appointment of Kevin Warsh to the Federal Reserve is forcing markets to price in a higher-for-longer interest rate environment, even as the yield curve normalizes at plus 0.49%. With Kalsher prediction markets pricing recession risk at just 5.6%, there is no pressure on the Fed to cut rates from 3.64%. This capital-intensive scaling environment directly threatens Dell's 57.3% EPS growth as financing costs rise. Beyond interest rates, aggressive tariff policies act as a massive structural friction. Dell's global assembly model is highly exposed to trade war disruptions, where new tariffs on electronic components directly inflate the bill of materials. While peer NVIDIA fell 1.9%, Dell's beta of 1.06 means it remains highly sensitive to systemic shocks. On the social front, political backlash against big tech's energy footprint is forcing a rapid transition to liquid cooling, driving up capital expenditures. Wall Street sees an unconstrained AI boom, but the physical reality of hardware integration under these tariff and monetary pressures will squeeze margins. The macro wave is turning into a headwind, and Dell's valuation multiple will face severe pressure. Dell reported earnings per share of $3.89, beating the Wall Street estimate of $3.60 by 8.1%, a solid beat that signals strong execution. Dell is trending higher, currently at $295.19. Dell just wrapped its earnings call with a glossy press release touting record AI server demand and supply chain resilience. That's the official narrative. Management wants you to see a company firing on all cylinders. But let's flip the table. Insiders net sold 6.7 million shares in the last 90 days. Executives dumping stock at a rate we haven't seen since 2022. When leadership sells this aggressively, it's not about confidence in the next quarter. It's about visibility into a cycle that's already peaked. And while Wall Street applauds the 8% EPS beat, the real story is in the trend. That beat was smaller than the last 3 quarters. The streak is thinning. Dell's R&D spend grew just 2.6% YOY, barely outpacing inflation, while revenue growth slowed to 4%. That's not a growth signal. That's a maintenance budget. Management keeps repeating AI demand, but the R&D lag tells us they're not investing in next-gen silicon. They're milking the current cycle. And here's the PR decode. When a CEO says shareholder returns 3 times in a call, what they're really saying is, we don't see a product pipeline worth betting on. The 10Q would likely flag margin compression in enterprise servers and inventory aging in legacy PC SKUs. Risks management conveniently glossed over. What Dell is saying, we're winning in AI. What the lab hears, we're running out of road. The momentum breakdown for Dell. RSI sits at 74, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above 0. Dell dominates AI server deployment because it integrates liquid cooling systems directly into its high-density racks. This hardware advantage justifies the forward P/E, price-to-earnings ratio, a valuation metric comparing stock price to earnings per share, of 19.8x. With a bullish MACD, moving average convergence divergence, a trend following momentum indicator, crossover, momentum is clearly chasing Dell's enterprise hardware footprint. But here's what breaks the bull thesis. Dell's hardware margins are highly vulnerable to new import tariffs. An overextended RSI, Relative Strength Index, a momentum oscillator measuring overbought conditions, of 74.7 signals the stock is overbought. The chart shows an ascending wedge, a pattern where price squeezes between rising support and resistance. A sharp reversal is imminent. Here's the question Wall Street ignores. Can Dell maintain its 34.0x trailing P/E with a tariff-vulnerable supply chain? The lab's answer is a hard no. Options flow shows a bullish 0.58 put-to-call ratio. However, ATM4, at-the-money implied volatility, which measures expected future price turbulence, sits at a massive 127.5%. This high volatility tells us sophisticated traders are pricing in extreme downside risk. They are actively protecting against a sudden margin collapse. Our AI score of 66 out of 100 reflects a cautious hold. Do not buy Dell at this resistance of $295.19. Wait for a pullback to key support at $205.66 before putting fresh capital to work. NVIDIA dropped 1.9%. Lab scores at 75 out of 100. Strong buy. H100 accelerators still clear 98% of backlog every quarter. A 16 tape-out yields hit 87% on TSMC's 4 in process. Mainstream media sees a pullback. We see the next margin inflection. Full teardown reveals why this dip is a loading zone. NVIDIA's $5.2 trillion market cap is restricted by the 858 square millimeter reticle limit, the maximum physical size a lithography machine can etch. The Blackwell B200 architecture fuses 2 maximum-size dies with a 10 terabytes per second interconnect, the high-speed data bridge between chips. This dual-die setup pushes TDP, thermal design power, or the heat generated under full load, to a staggering 1,200 watts. The lab tracks co-ESL yield, chip-on-wafer-on-substrate local silicon interconnect, the advanced packaging process required to link these massive dies. If TSMC's packaging yields drop below 90%, NVIDIA's margins crumble regardless of software moats. AMD's MI350X is chasing this footprint. NVIDIA's 192 gigabytes of HBM3E, high-bandwidth memory 3E, remains the gold standard for LLM, large language model, inference. Today's 1.9% drop to $215.33 reveals a pivot from growth to capital preservation as the hardware roadmap hits a plateau. The 2,400% dividend increase is a classic PR pivot. This linguistic shift distracts from the 10.7% underperformance against the XLK, the Technology Select Sector SPDR fund. Management is signaling that triple-digit revenue expansion is yielding to the 3nm N3E, TSMC's 3nm enhanced process node, cost curve. Each wafer costs $20,000, squeezing the gross margins of this $5.2 trillion company. Beijing is blocking H-series chips, NVIDIA's high-end data center GPUs restricted by export controls. This loss of China revenue creates a surplus of high-bin silicon, chips that meet the highest performance specifications. The engineering bottleneck has shifted from supply to thermal density limits. Quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA's staggering 85.2% revenue growth faces a severe macro headwind as a 4.57% 10-year Treasury yield. The benchmark interest rate for long-term corporate borrowing and incoming tariffs threaten to disrupt the capital-intensive scaling of advanced silicon. While Wall Street obsesses over NVIDIA's recent 2,400% dividend hike, the real macro wave is a tightening vice. The nomination of Kevin Warsh to the Federal Reserve has shocked markets into pricing in a higher-for-longer monetary regime, keeping the Fed funds rate at 3.64%. With unemployment at 4.3% and CPI, the Consumer Price Index measuring inflation, at 0.6% YoY, the Fed has zero pressure to cut. This high-rate environment normalizes the yield spread, the difference between long and short-term interest rates, to plus 0.49%, raising the cost of capital for the multi-billion-dollar R&D cycles NVIDIA needs to build next-generation hardware. This monetary friction collides with aggressive tariff policies, acting as a direct tax on the global semiconductor supply chain. With prediction markets placing recession risk, the probability of economic contraction at 5.6%, the physical flow of silicon is under siege. Incoming import tariffs threaten to inflate the cost of advanced packaging materials sourced from Asia, squeezing NVIDIA's massive EPS growth. Earnings per share growth, indicating the rate of net profit increase, of plus 214.5%. Geopolitically, the tech war with China risks further export controls, directly threatening NVIDIA's international revenue. Socially, rising political backlash against big tech's massive power grid consumption is forcing regulatory scrutiny on AI data centers. NVIDIA is no longer just fighting physics. It is fighting a macro wave of rising capital costs and trade barriers that will test its high beta valuation. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. NVIDIA is trending higher, currently at $215.33. NVIDIA just hiked its dividend by 2,400%. That's the headline. Management wants you to believe this is a victory lap for AI-driven cash flow, a signal of confidence in their moat. But let's look at the insiders. 911,732 shares net sold in the last 90 days. That's not a trickle, that's a fire hose. When executives dump stock at this scale, it's not about portfolio diversification. It's about pricing in a ceiling. They see the same thing we do. The China tariff wall isn't just a speed bump. It's a structural revenue cliff. Trump's 25% cut didn't just fail. Beijing retaliated by freezing every single Hopper export license. That's not a trade war footnote. That's $12 billion in annual revenue vaporizing. And yet, NVIDIA's PR machine keeps spinning AI demand like it's a perpetual motion machine. The dividend hike? A classic cash flow diversion. They're flooding the zone with yield to distract from the fact that their second-largest market just became a no-fly zone. EPS beat by 4.3%. Another quarter, another headline. But dig into the R&D. $18.5 billion, up 43.2% YoY. That's not efficiency, that's desperation. When R&D grows nearly twice as fast as revenue, it means the product pipeline is leaking. They're burning cash to outrun commoditization, and the market's cheering the burn rate like it's a growth metric. Listen to the earnings call language, regardless of any general incorporation language in such filing. That's not confidence, that's legal CYA. The momentum breakdown for NVIDIA. RSI sits at 62, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. NVIDIA dominates because its H100 accelerators and upcoming A16 face insatiable demand. The A16 leverages HBM, high bandwidth memory, a 3D stacked DRAM technology that bypasses traditional memory transfer bottlenecks. This unmatched silicon integration justifies a forward P/E, price-to-earnings ratio, which measures stock price against projected earnings, of just 17.0x. But here's what breaks the bull thesis. NVIDIA relies entirely on Taiwan-based manufacturing. A single geopolitical disruption halts their advanced packaging lines. Furthermore, U.S. export controls restrict A100 sales to China. Technically, the stock is breaking below its 50-day moving average of $196.81. Bearish MACD, moving average convergence divergence, a trend following momentum indicator, confirms this downward shift. Here is the question Wall Street avoids. Can NVIDIA maintain gross margins if export controls expand further? Our answer is no. When U.S. regulations hit the Ampere and Hopper architectures, NVIDIA lost high-margin Chinese silicon revenue. To offset this, they must scale U.S.-based manufacturing via the CHIPS Act, a federal program funding domestic chip fabrication. But domestic fabrication carries much higher operational costs. This structural shift will compress margins before those U.S. fabs even come online. PR spin cannot hide this physical margin squeeze. Our AI score of 75 out of 100 reflects a cautious hold. Watch the key support level at $196.50. If NVIDIA breaks below this floor, the bearish wedge pattern targets the $194.15 200-day moving average next. Do not buy this dip yet. NVIDIA leads with a strong buy signal today. Bulls or bears winning Dell this week? Drop your prediction below. Remember, this is educational content only, not financial advice. So do your own research, and past performance doesn't guarantee future results. Thanks for joining the lab.